Okay, wonderful. So let's start. First of all, thank you very much for joining another edition of Into the Blocks webinar series, where we try to cover some of the hottest trends in terms of crypto data intelligence, analytics, trading, machine learning, and things like that. Today we have a super exciting episode because we're gonna be talking about high frequency trading and DeFi. This is related to a lot of work that we do with quantitative hedge funds into building quant strategies for the DeFi space. I'm not in liberty of discussing very specifics, the specifics of many strategies that we build, but we're gonna cover a lot of the building blocks, techniques, things that we have learned that if you're into this space, you should pay attention to. And at the same token, we're gonna provide many of these ideas might provide a new perspective about HFT and the DeFi space. At the very end, I would like to present some more futuristic, ambitious ideas about the DeFi space from the HFT perspective that I think could make for an interesting debate. So the agenda is fundamentally simple. We're gonna start with some perspective about what DeFi represents to high frequency trading. And then we're gonna spend the bulk of the presentation talking about key building blocks of DeFi HFT strategies, like the infrastructure that you need to execute this type of strategies. And then at the very end, I wanna explore a couple of sort of more futuristic ideas that my goal is to make you think a little bit about this topic, about how the future of DeFi HFT could look like. A couple of logistic points. If you have any questions during the webinar, just use the Q&A or the chat. We're monitoring that, so I'll stop multiple times during the presentation to take questions. Before we start, though, I want to give you a quick update about Into the Block, like we always do. So, in a few weeks ago, we launched the what we call the Capital Market Insights, and this is a combination. This is a collection of over 80 analytics that compare Bitcoin and Ethereum against traditional capital market vehicles such as equities, commodities, ETFs, market indices. So given the current momentum in crypto, given the fact that there are many investors coming into this space from traditional capital markets, using this type of indicators, you can see correlations with crypto related stocks such as Square or MicroStrategy or Fan Stock or Tesla, or a specific ETF such as the Renaissance IPO ETF, or commodities like gold and silver and many things. It has been incredibly well received. Our customer base on the analytics side has been exploding. We typically don't disclose numbers, but it's way above 100 at this point, and on the institutional side. And this is a release that has been extremely well received. We have some major customer announcements coming up in the next few weeks, so stay tuned for that. Another widely requested feature that we added in the last few weeks is the fact that you can download data now from directly from the ITV interface. So just using if you're a premium subscriber, you have an option to download the data sets for any indicator that IntoTheBlock provides. Today, IntoTheBlock family of indicators is over 200. So it's a very large portfolio of analytics and indicators. And for each one of them, you can actually have access to the raw data underneath. So that has been a feature that our community or users requested quite a bit. It wasn't exactly simple to build. So we took some time, but it's finally here. And you can download either the images or the underlying data set. So that's what I wanted to share. That's what I wanted to share in terms of the update from the IntoTheBlock perspective. We have some very exciting announcements coming up in the next few weeks. So starting with today's topic about decentralized finance and HFT, this is an area that we're spending a lot of time. Obviously, IntoTheBlock is well known as a crypto analytics company. There is a division of IntoTheBlock that what we do is to work with quant funds, with hedge funds, building quantitative strategies using both machine learning, high frequency trading, and some other forms of machine intelligence to automate the execution of a specific algorithmic strategies. And we have been spending a lot of time on the DeFi space and thinking a lot in terms of the relationship between decentralized finance and the traditional high frequency trading. So speed and high frequency trading has always gone hand in hand. So since the early days, one of my favorite examples from a historical perspective is Nathan Rothschild during the Battle of Waterloo. During the Battle of Waterloo, he was able to access information about the fact that the Duke of Wellington had defeated Napoleon ahead of time because his couriers were able to get him that information before it was known by the British Parliament, and because in advance of the Battle of Waterloo, the British have lost a few battles to the French army. The bonds of the British government were completely underpriced. So Nathan Rothschild was able to buy those bonds ahead of time. And then when finally news reached that the Wellington has won the battle, the bonds completely appreciated, and he was able to offload an entire load of those. And that's in part, even though the Rothschild had many angles of the Rothschild family has as bankers has many angles of how they made their fortune. That day, it was certainly a pivotal time, a pivotal moment in their family wealth and legacy. That was the day that they based on information that nobody else had, they were able to multiply their wealth disproportionately. Obviously, electronic trading became a thing in markets in the 1980s, and high frequency trading started emerging in the early 2000s with the advent of dark pools and things like that. But it wasn't really well known. Obviously, most of you guys know that the book that pulled the curtain about this was a flash voice by Michael Lewis, and this book was very controversial, very well written. It certainly explained a lot of things that people didn't know about how frequency trading worked. It also made a ton of assumptions that I think were not really correct in terms of how markets work, but it was very controversial to the point that I think Flash Voice was published a few weeks before VirtuStream, one of the high frequency trading companies, was scheduled to go public, and they had to pull the IPO back because it was so controversial, and the sentiment in the market with respect to high frequency traders was really negative. But obviously, high frequency trading accounts for a double-digit percentage of the equity volume in the US every single day. And there are many strategies that have evolved in throughout the history of high frequency trading. You have a strategy such as index arbitrage, in which you're doing, let's say that you're looking at an ETF or a specific index, and you're looking at whether it's mispriced and try to arbitrage that with the underlying assets. There is event-based arbitrage, in which you're taking positions across different vehicles based on a specific news, such as M&A or a spin-off of companies. There is obviously statistical arbitrage, that is a very high frequency models that look for mispriced opportunities in different markets. More questionables are things like quote stuffing, in which you're trying to basically front run a specific order to try to increase the price by a very small percentage. And there are many variations of low latency arbitrage that are purely based on speed. So for decades, the sentiment around high frequency trading in Wall Street was that HFT firms didn't really innovate much in terms of technology. It was just speed. It was how fast can you put better infrastructure, more speed, not so much in terms of technology. I think that has democratized a lot, like all those things that you see about throwing cables and getting, that's really not the case anymore. Pretty much most of these large firms are playing on a level playing field, same type of infrastructure, and now there is more of intelligence execution of the strategies and things like that that comes to play. So from the perspective of traditional HFT, the way that you should think about HFT is speed. I mean, the key differentiator of HFT strategies compared to traditional medium frequency or other quant strategies is not intelligence. Most of these strategies don't use any machine learning or any sophisticated things like that. It's really speed, like how quickly they can place orders, how quickly they can spot opportunities. However, in traditional markets, unless you're dealing with something like dark pools and things like that, most of the time you're also dealing with intermediaries, you're dealing with market makers, you're dealing with entities, parties in a trade that you don't really know who they are or how they operate. So when it comes to DeFi, since the minute DeFi became a thing, I was fascinated by this because I believe that it introduces sort of a new dimension to high frequency trading that we haven't seen before. And then when you start thinking about what DeFi brings to the table in terms of traditional with the perspective of traditional HFT strategies, there are many things that are very unique. So, for instance, the state of the network, the market that we're dealing with, in this case, Ethereum for the most part in DeFi, is dictated by block state changes. So here you cannot place trades in nanoseconds or things like that. You're always limited by that block time. There are no trusted intermediaries. So you have near complete transparency. So imagine living in a world in which all your trades, all the trades of your competition is visible. So that creates both opportunities and creates a lot of risk, right? Whether before you're in traditional HFT, you're able to hide a lot of what you do or how you do it. Here is completely visible. So you can see your competition can see you in for the most part. Also, there is a lot of the market states are immutable and very predictable in a discrete fashion. So you can look at mempools and pretty much predict what the impact on price in DeFi protocols will be very accurately. Like it doesn't even require very sophisticated machine learning. Like you can just calculate it statistically, which is something that you cannot do in traditional markets because when you place an order, there is a lot of market making activity that takes place here in DeFi. Once you see a transaction in the mempool, you can clearly see if this commits, if this transaction gets mined, this is what's going to happen. Then variable transaction cost. So in traditional HFT, you pay the same for any transaction. Here, the cost of gas goes up and down depending on who pays more, which adds an interesting dimension to this problem. Then your code is visible. So you deploy smart contracts and people can see what you're doing. That's crazy. Like I'm trying to hide stuff from my competitors. And why do they have to see what we're doing? But then I can see the code of their smart contracts that they're executing. So this level of transparency, it creates a competitive dynamic that we haven't seen before. Then arbitrage is not a bug, it's a feature of DeFi. So many of these automated market makers protocols, they consider arbitrage as a component of the protocol in order to achieve certain level of efficiency. And this is another way of saying that arbitrage in DeFi is not going away anytime soon. And also diversity of protocols. So you're not dealing with a uniform vehicles in which you have an order books, you spot opportunities, you place trades. Here you have lending protocols, you have staking protocols, you have AMMs, you have all sorts of things for derivatives. So there is a diversity of protocols that paints a different perspective and opens all sorts of new opportunities for HFT strategies in DeFi. So this is summarizing this. You should think about DeFi and HFT in a way, in a good way to think about this DeFi and HFT is to think about the new dimensions that it adds to the complexity of executing trades. So for instance, in traditional HFT, two players that are technologically equal, given two algorithms that are technologically equal, they have access to the same data, they have the same execution capabilities, given an opportunity that they both spot, really the fastest one to execute is the winner of that opportunity. In the case of DeFi, obviously, if one is more sophisticated, if one spots the opportunity and the other one doesn't, if one spots a larger opportunity, that's something different. But in the case of an equal playing field, in the case of DeFi, given the same opportunity and two equal players, then speed is one thing, but you cannot go too much faster because you're limited by block time. So people are going to see what you're trying to do. Then you have the execution cost. How much are you willing to pay for that opportunity? And then you're dependent on miners, right? You're dependent on that. Once you route a transaction, once you beat your competitors, you need that transaction to get mined, right? And miners play all sorts of shenanigans in this space as well. So there are at least those three dimensions. Execution speed is one traditionally, but cost is another one. And minor execution is another one. I was recently having this debate with one of our clients, who the founder of this fund comes from a very prestigious high frequency trading, traditional Chicago high frequency trading firm. He was telling me, well, HFT is always traditionally about speed, not about money. And I'm like, yeah, but in DeFi it's about money because you need to pay gas for those transactions, and people try to bet above your transactions, and all sorts of things happen there. So DeFi definitely brings new dimensions when it comes to understanding HFT. So a simple comparison here that will help you think about this. In terms of information, in traditional HFT, you're dealing with an imperfect game. Think that you're playing poker. You don't see what your opponent has. In the case of DeFi, it's near perfect because you see all transactions that are in the blockchain. You're seeing what everybody's doing except what's being routed through private pools and things like that. We're going to talk about it. In the case of cost, in traditional HFT, it's mostly fixed. I get an agreement with X dark pool or whatever, and I'm gonna pay these fees for transactions, and it's not gonna vary depending on the transaction. In the case of DeFi, it's variable. So you pay a certain amount of gas. If somebody pays more, the transaction gets mined. Speed on a traditional HFT is factoring nanoseconds, microseconds type of thing. Here you're limited by block time. So you cannot go faster than the network. And then external infrastructure dependencies, other things, right, that could happen in traditional HFT that doesn't exist. Your ecosystem is your DApp pool, is your exchange that you're dealing with. That's your playground. You're not going to be exposed to something else in the infrastructure that gets introduced. Here, you're dealing with things like miners, mixers, and things like actors in the network that you're not always exposed to. So you have to factor that in the within certain amount of probability that what's the probability that your transaction gets mined or that a mixer gets in between and things like that. So this is a simple comparison between traditional DeFi, traditional HFT, and DeFi HFT. So infrastructure, by far, if there is a point that you should take from this presentation, is that better infrastructure beats strategies in DeFi HFT all the time. So it's not about having the best trading strategy, the best idea. The best building the infrastructure for executing this is brutally hard. It's difficult all throughout. So building those key components is essential to be able to compete at a scale. And this is an area, obviously, that we spent a lot of engineering effort to get to that point. So what I'm going to do for the next few minutes is present to you a series of key building blocks that are required in HFT DeFi strategies that probably you haven't thought about it if you're not in this space, or they're not so trivial, or probably you thought about it, but I might try to add a different dimension to this and probably help you think a little bit more about this new space. So one of the components that we find incredibly valuable is the capability of monitoring mempools. So imagine that you're doing something like arbitrage between Uniswap and Balancer or different AMMs. Monitoring mempools give you the ability of seeing transactions that are about to be, that have a probability of being executed, and try to forecast if they're executed, what's going to happen. And based on what's going to happen, you're able to get ahead of that opportunity a little bit ahead of the competition. So the way that typically works is you can build a component that is either hosting an Ethereum node, It could also be using APIs, but because the speed is important, we think hosting Ethereum nodes or using a platform like Blockdaemon that is really good at this stuff, and a partner of ours is very important, and because it gives you an edge in terms of speed, so you can look at the mempool, see the transactions, and algorithmically, depending on the strategy you're executing, saying, well, if this one executes, is that an opportunity for me, right? And what should I do in return? And that becomes the signal of your opportunity. So the monitoring mempools, key infrastructure building blocks for DeFi strategies. Then we have been talking about gas, about cost. So every transaction that you execute in DeFi, you need to assign a gas to it, and depending on that, it gets mined or not. So what happened in HFT DeFi is that once you place a transaction, somebody's going to try to front run you, and you need to bid against them. So there is a gas cost associated with each transaction. So a technique that has been very effective for us is to try to accumulate gas when it's cheap. This is far from trivial, and we struggle to figure out the right way to do this. To this point, I'm not even sure if the solution we have is the best one. But essentially, a mechanism that we find very effectively is using watt-in sheet tokens that are essentially a tokenized representation of gas. And based on some forecasting models, if you go to the IntoTheBlock platform, you're gonna see some visualizations that we use to analyze the price of gas, and we use many of those indicators to try to forecast when will be the best times to accumulate gas, and then use mechanisms in which you can buy those mint those sheet tokens ahead of time when the gas is really cheap, which is not doesn't happen very often these days. Look at all this red, but when it's cheap, we accumulate it, right? We spend money up front because when we're trading, we know that we have cheap gas and we can beat our opportunities more aggressively than our competitors, right? So that's an infrastructure building block that is really important, right? Being able to accumulate gas, it means that you need to spend money up front in order to have reserve that allows you to bid very aggressively on a given execution. Then continuing on this trend, now you have cheap gas, right? What do you do with it? So the way that if you're trading in Uniswap or in Balancer as discretionarily, you're getting front run, right? That's just the way it is. You place a transaction, there are bots that are gonna try to park themselves ahead of you, place another transaction, then sell you that same order on the way back. Algorithmically, when you're trading algorithmically, it happens too. Most of the front runners in the market are not very sophisticated. So we found it's a very easy way to shake them off. So once we place transactions, typically they're front running bots that try to get themselves ahead of us, but essentially you start bidding higher and higher with certain heuristics. And because if you have cheaper gas, you can, after the second or third attempt, they get off. However, there are competitors that do bid very aggressively, right? Because they spot an opportunity. They think this could be a $1,000 opportunity, and they're gonna go high to spend $980 in gas in order to materialize that opportunity. So you start bidding, and so you price the transaction, start monitoring the mempool, identify somebody's trying to front run you or try to place a transaction ahead of you, recalculate how much gas you want to play, either cancel, say, I'm done, I'm going to cancel, and see if your competitor, sometimes you cancel, your competitor canceled too, and you can re-enter that opportunity. Sometimes you cancel, your competitor continues, and they win that opportunity. Or if you decide not to cancel, you reprocess the transaction with the new fee, send it, and this cycle starts all over again, right? So it's a very competitive process. In some strategies, you see crazy competition. In many others, it's not that bad. But there is a lot of there is a lot of active DeFi trading in this space. So meta point here is if you have a good idea for a DeFi trading strategy, if you think that is somewhat obvious, like compound liquidations and things like that, there are like a million competitors, right? The ones that you don't get a ton of competition are the ones that are not very obvious. And for the most part, there is always some level of competition that you're going to experience, more or less sophisticated. So one mechanism that is typically is tricky as hell, but it's good to consider to shake off competitors and to try to place transactions in a way that they cannot be uh, that they cannot be spotted by the competition, is to use private pools. So a lot of the HFT these days, this is not a secret. It happens in private pools. And the way this typically works, there are different platforms like Blockshroud, ArcherDAO, or Taishi Network. We like all of them. But the way you should think about this is once you have an opportunity for a trade, you calculate the size of that opportunity. And based on each one of these platforms will give you a probability that that transaction gets mined in a private pool. So what these platforms do more or less is they have relationships with miners and using different criterias, right? They place a transaction directly with private mining pools, and then that transaction gets mined, but your competitor is not seeing that transaction in the mempool ahead of you. Now, the thing is, many times those transactions don't get mined. So you send a transaction to a private pool and it doesn't get mined. So you lost the opportunity entirely. And there is a cost also associated with doing that. So typically what you do is probabilistically to estimate the chances of success of sending that to a private pool compared to the size of the opportunity. Sometimes it's better to go in a full bidding war with your competitor. Sometimes it's better to take your chances with a private pool, knowing that if it doesn't work, you lost that opportunity. So that's very interesting. The integrations are tricky or difficult. The infrastructures are not great. And all sorts of crazy stuff happen. But looking at these things is certainly a good practice in terms of infrastructure building blocks. Then, similar to this, another technique is to obfuscate the inputs or part of your transaction. So we imagine that you're placing transactions, but you're actually encoding, encrypting, obfuscating parts of it. So if somebody's looking at the mempool and just trying to read the inputs of the transaction to determine if they want to compete with you, if those inputs are obfuscated, they cannot read it. So we have played with techniques that use select different obfuscation mechanisms randomly from a pool and said like this transaction, we're going to obfuscate it this way, this one, this other way, and things like that. And we are the only ones able to understand what it said. So if your competitor is sort of simplistic about this or not that sophisticated, and all they're doing is monitoring the mempool to try to see the input, you can trick them with that. But there is another way to avoid this, and we experience competitors that are sophisticated enough that what they do is they try to replay transactions. So you can actually host depending of different Ethereum clients, you can host Ethereum clients that give you the ability of replaying transactions. So you can take any transactions, any state of the mempool, replay it offline, literally in microseconds, see the impact of a transaction as a simulation, and determine whether you should compete at that point. So a funny anecdote, in one of the opportunities that we compete very aggressively with another very highly sophisticated firm, at some point we start doing the encryption part and we were able to trick everybody, but one bot that immediately started competing with us even when our transactions were obfuscated. And that's how we knew that they were using a replayer, right? And we're using a replayer too. It's very difficult to implement, right? Like you need to install a ton of things and then computational expensive, and you need to execute those calculations very quickly, because if you take 10 seconds then the block goes by and you're done, right? So you need to execute very quickly. about this. But if once you have that infrastructure, what allows you to do is essentially you can look at any transaction, anything, yours or any strategy, right? And just replay it and see, okay, this is gonna produce $200. So do I want to get in that opportunity? So it gives you sort of that idea. Easier said than done, right? You can look at that. This chart here is not gonna tell you anything of how it's done. It is there is a lot of building blocks to get this work to get this done and from the engineering standpoint, but conceptually, that's the main idea. So other relevant building blocks that we find is, for instance, signals from CeFi exchanges, right? Like there are many times there are massive arbitrage between CeFi, DeFi, depending of the type of strategies that you're implementing. So there is a ton of opportunity on incorporating CeFi signals and also execution on CeFi exchanges. Multi-protocol integration, the idea of having many strategies that can execute across many protocols like Uniswap, Balancer, Aave, Compound, and things like that. Each one of those legs requires custom smart contracts that integrate with those protocols and things like that. But if you do have them, right, it gives you the opportunity of executing across a ton of protocols and then extrapolating that idea even further. DeFi is becoming a game beyond Ethereum now. Binance Smart Chain is here, right? And it's active and it has a ton of volume. You're seeing what Solana is doing with Serum. We're seeing some things in Algorand that are interesting. So this is going to happen across because the gas fees are unsustainable in the long term unless Ethereum 2 solve that somehow, which it should. But in the meantime, there is a window of opportunity for other blockchains. So multi-chain execution is very interesting. And we're starting already to do things across Binance Smart Chain and other blockchains. So this is certainly something to keep an eye on. All right, so to finalize, I want to present to you two crazy ideas about things that we have been looking at in terms of DeFi and HFT. We don't have any results. We don't have anything to share. We haven't really done any engineering work about this. Is mostly research and experimentation, but trying to imagine what is sort of the maximum expression of how this space could look like in the near future. Like we're not talking about something that 3 years from now, like something that is here and is probably possible today if you try hard enough. So one idea that we have been playing with is this, what we call the automated HFT strategy learning. So I mentioned a replayer, right? Imagine that you have the opportunity of taking any transaction, replay it, see the outcome, or look at Mempools for a specific real-time transactions. So there are machine learning techniques such as reinforcement learning that is what was used to build the AlphaGo system that beat Lisidol, the Go World Champion. Is also what was recently used to build this thing called AlphaFold that solved a massive problem in terms of protein folding. Is a quincentennial problem in biology, using this type of trial and error technique, right? That it tries something, it doesn't work, or it works and it gets better. So for instance, this type of systems learn to play Go by playing Go, not by learning the rules. AlphaZero, right? AlphaGo was trained, but AlphaZero learned by playing. And in the techniques like that, we have been thinking, well, if you have all the transactions and you have all the impact that those transactions cause, instead of going the traditional way of some of our quants trying to design strategies and test it, could we have algorithms that are inferring strategies on the fly based on what has happened in the past? Because you have access to the entire state of the blockchain. And once you have that, so you start with historical transactions, you train a reinforcement learning model that's going to give you a catalog of potential strategies, and then you start monitoring mempools for new transactions, and then you have the state of the market, right? There is this transaction, the Ethereum price is here, this is the state of the market. Based on that, it will say, well, the last time this happened, these strategies were effective, can I trigger? So those sort of ideas, right, of just learning every single strategy that is out there automatically instead of learning one strategy at a time is interesting. And then another one, a little bit more trivial to explain, not so simple to implement, is what we call tokenized HFT strategies. So we have things like Y-earn and protocols like those for passive yield generating strategies. Well, could you have something for HFT active strategies the same way, right? Like, could you, if you're willing to take risk as a retail investor, can you have all these algorithms in a tokenized form? Right? That investors can either put their own money or other bots can use it as part of their strategies. And then I have a bot that does arbitrage across a ton of AMMs. And then you can give me money. We're not doing any of this, by the way. All our clients are institutions. But this is an interesting idea, right? Like if DeFi is all about programmability and automation, right? Couldn't you take a lot of these strategies and make it programmable out there, assuming that if you deposit money into those, you're assuming risk, right? Like you do with other DeFi protocols today. But the DeFi market is so inefficient these days that you can make a massive return in some of these opportunities with a relatively small amount of capital. So those are ideas that we think are very interesting. So summarizing this, DeFi represents a new playground for HFT. So new rules, new dimensions, and many of the traditional DeFi strategies do apply here, but there is also all sorts of new angles to play with. Infrastructure is key. Remember, better infrastructure beats better strategies any day in DeFi. And HFT is a feature, not a bug of DeFi. So this is something that is here to stay and that you can agree or disagree with, right, about what the impact that it could have on the market, but it's definitely something that is happening. So I'm gonna this is all I have for today. I'm gonna go to questions. There is a pile of questions there, so do not leave just yet. But before you go, the next webinar that will be on March 17, we're gonna do the same thing, but instead of for active HFT strategies, for passive yield generating strategies. So we're gonna take you on a journey of what it takes to build yield generating strategies for DeFi protocols. So if you're not into high frequency, well, if you're not into high frequency, I don't know what you're doing here, but suppose that you got confused. You like more like passive yield generating strategies. There is also a ton of opportunity in DeFi, and we're gonna take you through some ideas there. The link for the webinar is in the chat, so please go register. It's gonna be awesome. If you want to follow up with me, this is my contact info, my email. You can contact me through Medium. I'm a very active writer. And with that, I'm going to go to questions. So Matthias is asking that if the ideas that we present are not limited by the block time, priorities are defined within a block, which and whether this also applies if there are scenarios in which we compete in a speed within the block. Yes, in some sense. So the order in which your transaction gets mined, it does matter. So many times you're obviously in the same block, you're trying to compete, and then you want to place your transaction ahead of anybody else, because if you get there, it doesn't matter what everybody else does. So speed is important. The concept I was trying to make is that if you spot an opportunity and you do all your calculations and all that in 300 nanoseconds, and you place it, you still need to wait, and people are gonna see it in the mempool, and it's still gonna be a few seconds before it gets processed. But then when you start competing on bidding and trying to bid again, speed is really important. Like we have strategies that we work on that there are computations that we know we want to execute and we cannot execute them because they take too long. They take a few seconds and then the opportunity is gone by the time that we complete those calculations. Then Anonymous is asking, could you share resources to learn about this? Yes, Anonymous, we're going to share the deck on our SlideShare, and then the video will be on our YouTube channel. Then Anonymous is also asking, do you think an arbitrage bot be efficient today in a high gas market? Yeah, I mean, there is gas is also is obviously one of the biggest detriment to HFT in the Ethereum network, but the opportunities are still there. So there is something that you need to deal with. It makes it competitive, so you get affected by it, your competitors too. So being able to estimate gas efficiently and things like that is it could be something that is a pain in the neck, but it's also something that you can take advantage of. Then another anonymous, no, I think it's the same question. Said maybe on Ethereum, maybe elsewhere. The bulk of this happens on Ethereum today. There is activity on Binance Smart Chain. There is activity on Solana, but Ethereum is still the king. How to make use of CeFi signals in HFT or non-HFT DeFi strategies? Oh, there are many ways. So you can obviously use oracles for this. You can use all sorts of API wrappers and things like that. If you're the only one consuming the signal, you can use oracles that they don't really require consensus mechanism. So you can have an API that is feeding you the price of a specific token in Binance with some criteria, and then your smart contract is looking at that and or something in Uniswap, and if there is an imbalance, that send you a signal that there is an arbitrage opportunity. There is also more interesting ways to arbitrage between CeFi and DeFi, but I probably need a session just for that. Like there is some super interesting techniques that you can do there. Brad is asking, I have a good success using bots to trade in centralized exchanges. Are there any projects to harness DEX into simplicity of a bot? Yeah, there are a few protocols out there. For active, I wouldn't. There is nothing that I will that I would recommend. For passive, there are great projects like YEarn and things like that that abstract the complexities of dealing with many liquidity pools and AMMs and another type of protocols. Will IntoTheBlock provide APIs? Is anonymous. IntoTheBlock does have an API for all our indicators. For the work that we do in trading and quant is really only for our customers. So there is no API for that. H Mogadishu is asking, how do transactions replay offline in a real-time HFT? You might want to send me an email about this. It's super complex to explain, but essentially using a specific Ethereum clients, you can replay, and it doesn't work for all Ethereum clients. You can replay transactions on the mempool and look at the state of the blockchain, right? Like is a feature of the client, and then but you need to understand what the state of the blockchain is will be, right? What you're doing is simulating if that transaction goes through, and then go back to the mempool and spot the opportunity and process it. It's sort of the way it works. Do you see front running? Do you see front running decrease or change with Uni B3? I heard so many things about Uni B3 that I don't know. I don't know what else to think. I don't. I hope. I mean, they're a client, so I hope there is nobody on the. They're a client of IntoTheBlock. There's so many changes and things that I seen that I don't know what to how to think about it anymore. But I don't believe you can get away the way Uniswap, unless you change the core protocol, that X times Y equals K formula. There is no way to avoid front running with that. So they will have to do massive changes in the protocol because that simple linear formula is prone to imbalances, right? So and that will cause that will attract arbitrageurs and front runners. So I don't see how that goes away. Then there is a couple of questions on the chat as well. Mauricio Zanetti is asking, do you think HFT could help solve or explore the issue of having a given crypto cost different across exchanges? Yeah, I mean, I don't think it's gonna solve it, but H, uh, HFT and arbitrage bots in DeFi are sort of an ingredient to make the market more efficient. So the way Uniswap achieves balances is via arbitrage, right? So I think this is there is definitely a contribution in that sense. At the same token, there is all sorts of parasitical side effects with this, right? Like you get the price of gas going through the roof is partially done to the. I mean, there is a component of that that is all the arbitrage bots that are placing transactions left and right and inflating the. Also, there is side effects on both ends, both positively and negatively. Um, then another question, can IntoTheBlock predictions in addition to technical analysis be used for in crypto trading? We don't do technical analysis predictions. So our predictions are based on deep learning models based on a specific data sets. And yes, it takes work, but yes, you can use it in trading strategies. Then another question, is there a way to get the signals through the APIs? Nothing related to trading, yes, for the predictions. Um, are there arbitrage bots, H Mogadishu again, are there arbitrage bots interacting with private pool to feed the data in Mempools? Uh, Not sure if I follow the question, but maybe somewhat of an answer will be there is a ton of the HFT activity today takes place in private pools, so it is a fact. And there is companies like Bloxroute that has about 30% of the hash rate, and of course they're a relevant player. And then there are miners that are also doing HFT to and try to front run transactions, on their own. So uh, that's uh, that's sort of the game these days. I think that's it. Well, thank you very much for joining me and staying so late in on this. And I really hope to see you in the next webinar. I hope you enjoy the content. I will be posting it online in the next few hours. Thank you very much.